Hello, and thank you for joining us today. So in the next few minutes, we're going to be talking about how you can use PPPs to take advantage of a market downturn and how pension legislation actually enables you to create tax leverage in turbulent markets like the ones that we are facing today. So joining us today is JP Laporte, CEO of Integris Pension Management Corp. JP is a pension lawyer with over 20 years of experience in this field, and he is a nationally recognized expert in pension law. So thank you for joining us today, JP.
Glad to be here.
Great. So let's start with talking about personal pension plans. Personal pension plans are relatively new. IPPs or individual pension plans have been around a long time, but personal pension plans provide a new take on this concept and actually provide a lot more flexibility for business owners who set them up. And they're made up of three components. So there is a defined benefit component, which we call it DB. There is a defined contribution component, which we call BC, and there is an additional voluntary contribution component that we call it AVC here. And you have the choice of changing formulas between defined benefit, defined contribution, anytime that it suits you. So it gives you a lot of flexibility, and we will be talking about that in more detail when we get a bit further in this presentation. So let me start with an example of a pension plan that started January of this year with $1 million of assets. And these assets were invested in the TSX. According to the pension formula, this pension plan should have $1,075,000 by December 31st of 2020. That's because the pension formula uses a 7.5% compound average annual rate of return to do the valuations for the pension plans. But we all know what happened in the first quarter of 2020. It has been one of the worst on record. So this pension plan dropped by March 23rd of 2020 to $660,000 in assets, a drop of 34%. If this money was in an RRSP, there would be no tax savings opportunity because that's a tax sheltered environment and there's no tax strategies that could be used inside an RRSP. However, in an IPP or a PPP, you can use a strategy called ad hoc actuarial valuation that can help create a huge contribution room during a market downturn, and you can use the situation to take advantage of more tax sheltering opportunities. So JP, maybe you can tell us more about the sources of cash that a company can use to take advantage of this extra contribution room.
Sure thing, Tina. So here on this slide that we see that we have an operating company that's sponsoring the PPP, and it's held or owned by a holding company. And what this business owner has done traditionally is when the operating company was generating profits, some retained earnings were transferred intercorporately to the holding company with no tax. And now the holding company would open up an investment account and invest this cash in various asset classes. Unfortunately, those dollars are considered passive corporate investments, so they get taxed at a very high rate inside the holdco to start. The other problem that this structure has is that under the new tax on passive investment rules that the federal government introduced in 2018, once these passive corporate investments reach $50,000, for every additional dollar of passive asset income, we have $5 of the operating company's $500,000 small business deduction limit being eaten away. So the $1 to $5 grind, every time Holdco or Opco generates passive assets above this $50,000 buffer, this safe amount. So you can see that one of the ways in which we can help take advantage of the market correction is if Holdco lends that money to OpCo through an intercorporate loan, and then OpCo can inject it into the PPP as a special payment. And what this will do, it'll do a bunch of things. First of all, the interest that OpCo has to pay Holdco for that loan will become a new corporate tax deduction for OpCo, which is a nice bonus, and you can't do that with an RSP. But more importantly, we're also protecting OpCo's $500,000 small business limit, because that money is no longer causing any tax on passive investment problems for OpCo, because it's off the balance sheet.
Mm-hmm. Very true. And when it comes to the ad hoc actuarial valuation, you can actually pick a date and have it done, let's say, as of March 31st of 2020 to take advantage of the lowest point in the markets, right?
Exactly. That's what the crystallization of the ad hoc valuation does, is it picks the date where it has to be a month end, but it picks the closest date to the trough where we had the largest possible deficit, and it records it. And now that gives the operating company the ability to contribute more money to the pension plan and claim that as a corporate tax deduction.
So would you say it's a good strategy in a turbulent market like today's to wait until the end of the year and then pick the month where was closest to the lowest point in the market and have the ad hoc actuarial valuation done as of that date?
That's a good question. I mean, we can always refile an ad hoc valuation if need be.
Okay.
So we could file one in March and one in January, for example, of the next year, if the markets took a beating in December and capture all of the losses. So there are ways to crystallize those losses at different points in time. But I feel that if you can get taxable corporate passive monies out of that world into a tax sheltered pension plan sooner rather than later, you have all that money working for you inside the PPP.
That's a good point. And it's impossible to know exactly when the bottom is for the markets.
Or if there will be one for a while. Yeah.
Exactly. So let's talk about, OpCo injecting cash into the PPP.
Yeah, so here you can see that by having OpCo injecting this cash in the form of special payments, it creates tax deductions within OpCo, which can be used up if it's been a good year, or carried forward if we expect that there'll be profits or corporate taxable income in the future. But what's, like I said before, what's really nice here is that the cash is no longer on the books of either Holdco or OpCo. So it means that we don't have a tax on passive income problem. Instead, we're growing that capital in a tax sheltered manner. And here's another thing that's not even part of the slides, but if we ever wanted to sell the shares of OpCo in order to trigger the lifetime capital gains exemption, by having removed this passive asset out of the company, it purifies the company.
That's true.
And gives the shareholder access to the, I think this year is something $870,000 lifetime capital gains exemption.
Yes, very good point, actually. And on top of that, markets that have dropped so sharply are not going to stay low forever. And a pension plan is a long-term investment. So over the long run, this is a great opportunity for bargain hunting and creating, big growth inside the pension plan. And then, the options, obviously, if there's a huge surge in the markets, you can ride that recovery curve And if you want to get more conservative later on, you can always take profits inside the pension plan without having to worry about triggering capital gains and tax consequences. And you can move some of the money into bonds or GICs. You can also just be a buy and hold investor and ride the different market cycles into the future. And if markets correct again, you can always do another ad hoc actuarial valuation a few years down the road when the next market correction comes. So JP, tell us about the excess surplus and the magic 9.375% rate of return.
Yes. So of course, if you followed Tina's advice and you bought cheap to sell dear and made a big profit, the rate of return could be well in excess of 9.375%. And 9.375% is important because it tells us what kind of rate of return will cause the pension plan to trip up into what we call excess surplus. So excess surplus is a tax concept that says there's too much money in the pension plan for the promised benefits or liabilities inside the plan. So the problem with excess surplus is, well, there are two problems. The first one is it forces the company that set up the plan, in this case OPCO, to go into a contribution holiday mode. So it's no longer allowed to contribute to the plan. Therefore, it can't write off any more of those contributions. So all of the tax sheltering disappears for annual contributions. In addition, because the pension plan stays alive and you continue to collect a salary and we continue to add years of service to the pension plan, there's also a pension adjustment that's created, a PA or pension adjustment. And that pension adjustment virtually eliminates your RSP contribution room.
Mm-hmm.
So we have two problems. The company can deduct and the individual can deduct because of this excess surplus. So
True.
that's the issue. But the solution, of course, is to shift from the overfunded defined benefit account, the IPP side of the plan, into the money purchase or defined contribution side of the plan, the DC plan. And what that does is that it means we're no longer adding more years of credited service to the defined benefit formula. Therefore, we're no longer having large pension adjustments.
Which is a unique feature of the PPP, for sure.
Yeah.
And no large defined benefit pension adjustments mean that, you know, next year you're going to have RSP contribution room, and you could contribute 17% of your T4 income to your RSP. And obviously, any existing RSPs that you have, you always have the option of moving that into the AVC or additional voluntary contribution portion of the PPP. So maybe JP, you can tell us a little bit about that and the advantages.
Yeah, sure. So, of course, the transfer is done under the authority of a CRA Form T 2033. So there's no tax when you transfer the RSPs into the pension plan. But what happens is that all of the investment management fees that you were not allowed to deduct while the assets were inside of an RSP, now because they're part of a pension plan, those same investment management fees become tax deductible to the corporation. So that's advantage number one. Number two is that when there are sales taxes like HST or GST levied on those fees, the input tax credits can be claimed by the corporation. Mm-hmm. So it makes the plan HST free. Unless you're a doctor or some of the professions where you're not allowed to claim input tax credits because of the type of supplies you're giving. But for most people, that's not a problem. And then the third massive advantage is that now that the money is no longer RSP, but pension money, it gets the full protection of the Pension Benefits Act. So now creditors can't try to get their hands into your retirement cookie jar.
Which is a great benefit for business owners, especially in these very turbulent times in the economy.
Mm-hmm, oh, for sure.
So the PPP definitely allows you to buy the dip with tax-assisted dollars, and the tax-sheltered growth inside the PPP will allow you to grow this extra contribution that you can make to it on a tax-sheltered basis. And obviously, it provides protection of the small business rate for the operating company because we're removing the passive income and removing the small business grind for the operating company, which means you will not have to pay punitively high taxes on the passive corporate income that are invested in the corporation. And you're effectively moving those assets into a tax-sheltered environment where the capital can grow tax-sheltered inside your pension plan. So it is definitely a very effective mechanism for handling the excess surplus. It will allow you to benefit from personal tax deductions by making RSP contributions during the years that you have switched the formula from defined benefit to defined contribution. And you will get corporate tax deductions on your investment management fees, which is not possible with other registered plans such as RSPs. So thank you so much for joining us. JP, do you have anything to add?
Well, the only thing I wanted to say is that now your clients will have this in their back pocket if we have another market correction.
Very true, very true. It is a underutilized strategy for sure. Not very many people know about it. And we are very happy that you could join us and learn a bit more about how to use the strategy. If you have any questions, please feel free to reach out to me. You can contact me at titehranchian@asante.com, and we can talk about customizing your own PPP and retirement planning strategy for you. Thanks again, and thank you very much, JP, for your time.
Bye-bye.
Bye-bye.